Hello and welcome to introduction of our great forex program. And you're with Mo Levi, a forex analyst and trainer from Matrix Management Services Limited, dedicated to replicating the knowledge of the trade to many around the world. And as you pay attention to every bit of this program, you're going to be becoming a genius in FX, because we're going to be highlighting you to the fundamentals of the trade, and the way we are going to be putting you at an edge in the very lucrative world's most largest market business. The trade forex is the biggest market in the world, and day after day price fluctuates in the market, making it very advantageous for those that are going to be analyzing the market at various price levels. Now, as you pay attention to the class, we're going to be highlighting you to most of the fundamentals that you need to really make it a resultant by making money rolling in your pockets. Let's get started. So we're discussing what is forex, we're discussing currencies, we're discussing understanding the times for trading, peaks and profits, cost of trading, types of orders, what makes FX superior, and then what moves the forex market. As forex popularity increases to unprecedented levels, people around the world are considering its potentials. So there are many reasons for its popularity. First, we are truly in an online revolution powered by the globalization of the internet. From your desktop, whether at home, an airport, or at an internet cafe, you can actually trade any of the world's currencies. The implications are profound. People can be liberated from the confines of one's economy and engage in a new profession for trading. Additionally, globalization of the world's economies has created greater certainty regarding individual career paths. Individuals can now no longer expect to work for just one employer. Baby boomers are facing the opportunities and challenge of post-retirement careers. These words of Abe Kovnas, our forex guru. So now, getting started. Forex, the largest financial market globally, is used by a variety of participants from all over the world, with a daily turnover of $5 trillion US dollars, and these include institutional traders like JP Morgan, Morgan Stanley, and Citigroup. The central banks of the world intervene and monitor the health of the global financial markets, namely the Federal Reserve Bank, which is an American central bank. They have the ECB, which is the European Central Bank, and they have the Bank of Japan, just to name a few. So there are retail investors, the small time speculators who make money out of the markets every day. So these are no longer, there is no larger and more liquid financial market than the forex market. So that is why you just take advantage of the forex market. A lot of dollars roll over us every day, and from the fluctuations and the liquidity and the high volatility in the market, it gives you an edge to really make resultant profit on a daily basis. So the major exchanges like the New York Stock Exchange and the Tokyo Stock Exchange pale in comparison, as they only account for just 22.4 billion US dollars and 18.9 billion US dollars trading volume per day. Now, in this very unique market, very good to know what is being traded there. So these are currencies traded in this unique market. outlining currency, the country, the currency, the abbreviation, the symbol, and then the nicknames. So, but first of all, we're going to be looking at the United States of America, and the currency the dollar, and the abbreviation the USD, and the nickname is the greenback. We have the Eurozone, the currency the euro, the EUR in abbreviation, and it's called the fiber. We have the Japan, and the currency the yen, and the JPY is the abbreviation, and the nickname is yen. United Kingdom, the currency is the pound, the GBP is the abbreviation, and it is nicknamed the cable. The Australia, we have the Australian dollar, the AUD in abbreviation, and is nicknamed Uzier. Switzerland uses franc as a currency, and the abbreviation is CHF, and Swizzy is the nickname. We have Canada, which uses the Canadian dollar, and the abbreviation is CAD, and the nickname is Loonie. We have New Zealand, and we have the New Zealand dollar, the NZD is the abbreviation, and Kiwi is the nickname. So these are the world's major currencies in the global financial markets, currency markets, and we will be dealing more on them as the program continues to go on. So just pay attention as we expatiate more on them. So the FX market, as we have seen, is a place where currencies are traded, and so these are the basics of the trade. Foreign exchange deals are in instruments that come in pairs. Examples are Euro CAD, Euro versus Canadian dollar, GBP JPY, which is the Great British Pound versus the Japanese Yen. I have the NZD USD, which is the New Zealand dollar versus the United States dollar. So the thing being dealt with in the forex market are in pairs. There are instruments that come in pairs. In other words, not just one currency, but they are dual currencies. Like the example we have seen the euro versus the Canadian dollar. That gives it an edge. So when one currency is devaluing in price, then we can take advantage of the other one that could be gaining strength in that order, so that we could buy one currency and sell off the other currency, and then we make instant profits just by articulating and buying what you buy, and then selling when you should sell at the lows and the highs respectively. So we can observe that from the examples above, instruments traded are in pairs. So the currencies are, the left is called the base currency, while that at the right is called the counter currency. For example, we have the Euro CAD, which is the first currency we mentioned above. So the euro is the base currency, while the Canadian dollar, which is the currency at the right, is called the counter currency. So when the base currency devalues in price, then we can take advantage of the counter currency and to sell off the base currency, and we will be making profit from that scenario. But when the base currency is gaining strength and the counter currency is devaluing in price, then we're going to be taking advantage of buying the base currency and selling off the counter currency, and that culminates into bringing money into our pockets. But we're going to be dealing that as the program commences. So this is an introduction. So this is a typical GBP CHF chart, and in the chart we can see horizontal red lines, we can see a trend line, you see this trend line, and we can see horizontal lines like this and this one, and then you can see the moving averages. So this is a chart, and this is where the money is being made. So what we do here, we predict at the low, buy from the low, predict that there's a low, and we buy from there, and we predict that there's a high, and then we sell off from there, and then we make profit in both scenarios in the forex market. That makes the forex market very advantageous and very unique in its nature. So a charting software is available for trading the market for anyone who cares. So when trades are carried out, they measure in terms of the counter currency. For example, the Euro USD at a price of 1.0985, meaning that 1 euro is equal to 1.0985 US dollars. So we had a reading GBP JPY at 169.790. So it means that 1 British pound is equal to 169.790 Japanese yen, and so on. So the US dollar, which is the top currency at the book table, is the world's most traded currency and is commonly referred to as the global currency. So this is due in part of its nature as the global standard amongst central banks and how liquid and recognizable it is. So to put it in a more global perspective, the US dollar accounts for 80% of all forex transactions globally. As you can imagine, there are a lot of US dollars in a $5 trillion daily market. The instruments traded in this market are either major or minor pairs. Later we shall be discussing more in the program. The major pairs are pairs that have the US dollars, for example, the Euro USD, the GBP USD, the AUD USD, the NZD USD, the USD JPY, USD CHF, and USD CAD. While the pairs without the US dollar in common are called the minor pairs, and they are Euro JPY, we have GBP CHF, and we have AUD CAD, and we have AUD Australian dollar, New Zealand dollar, and so on and so forth. So minor pairs can be further grouped into crosses such as Euro crosses, Yen crosses, Pound crosses, and easier crosses, etc. Now let's look at some terms in the trade. Let's get some terms in the trade. We're going to be looking at what the short position means. So short positions. So the short position means the sale of a currency with expectation that it will fall in value. That is what a short position means. So we can say short the US dollar, which means we should sell of the US dollar. Or we say short the British pound, which means we sell of the British pound with expectation that it's going to fall. So when we say long position means buying a currency in expectation is going to rise. So if you say long the US dollar or take the US dollar long position, which means we should buy the US dollar. So margin, what is margin? Margin is a word that is frequently used in the market, and the margin is the amount of money required in your account to maintain your market positions in order to cover some or all of the credit risk associated with borrowing money on leverage. Margin call. Margin call is a level set by your broker that defines a minimum amount of money required to trade in the market. So when your account's value falls below its level, you will be asked to deposit additional money to maintain your positions. Alternatively, you can close some of your positions to reduce your required margin. We have a word called leverage. Leverage is a facility offered by the broker to help the trader trade large amounts while only holding a small amount of capital compared to what you are trading. So and then you could have a leverage of 1:100, and when you have a capital of $1,000, then you are trading with $100,000. So that's what makes the FX very exciteful and very prospective, because there's high leverage that gives you an advantage to trade large capital just holding just a small. So we have what they call swap. We shall discuss swaps later in the program. Some of this is just an intro. As we said, we're going to be expatiating on these words as the trade as the program commences fully. So but this is an introduction. So we're going to be highlighting even on stop out. So then this very important aspect of the business, this very important aspect of the course. So how do we then make profit in this market? How do we then make profit in the market? Fine. So this is very insightful, and this is it. First of all, we could we shall look at the word pips. We shall look at the word pips first of all. So it's one of the most common used words in the trade, and you would like it. So profit and losses are calculated in terms of pips. So now, what is the pip in FX? It means price interest point. Price interest point. So before you talk about profit and losses in the FX market, you're going to be counting them in terms of pips, and pips are points. The reading of points in the currency market. So a pip is the fourth decimal place in the currency value. For the yen, it will be the second decimal place. So Euro USD, for instance, at a price of 1.3124, 4 is the pip in this very value. For the yen, it will be the second decimal place. For instance, the GBP JPY at 169.79. So the 9 is the pip value. You bought Euro USD, for instance, at 1.3214 and then sold Euro USD at 1.3228. So you made 1.3228 minus 1.3214. You have 14 pips because the price rose from 1.3224 and then went to 1.3228. So 1.3228 minus 1.3214, just simple arithmetic. So you have 14 pips. So you moved 14 points. 14 points. So when you're trading one standard lot in forex, standard lots are quantities of measurement in the forex market. So when you're trading one lot of Euro USD, one pip is have a monetary value of $10. So the profit is being calculated, the 14 pips that moved, from 1.3214 to 1.3228, then which is 14 pips times 10, which is the quantity you are selling at the time, and the what you have in monetary value is $140 US. Very simple, right? Very simple. So the pip values will always differ between pairs. Totally differ between pairs. So now let's look at the word spread. Look at the word spread. Spread. With all trading, there is a cost for entering in and out of positions you have in the market. In forex, you are charged the difference between the bid and the ask price. This is called the spread. So the spread is the amount that the broker gains for your going in and out of the market. Example: when you have Euro USD, Euro US dollar at bid price 1.3241 and the ask price at 1.3243, the spread is currently 2 pips. So your trade will cost 2 pips, right? Okay, that's what the broker is going to be getting from that, and that is the commission they get for giving you access to the foreign exchange markets. What makes FX period to other markets? This is a big one. You're going to pay attention to this so that you know why FX is superior to other markets, why you can take advantage of the forex market over other markets. Forex enjoys 24-hour trading, so you can trade in the night, you can trade in the morning, you can trade in the evening and afternoon, and wherever place you may be around the world. While the equities and the bond markets only open during the exchange business hours. In forex trading, we have typical no commissions on trade and very tight spreads. So at times we have no commission, at times we have just very tight spreads. While in equity and bond markets, commissions are paid on every trade executed. So in forex trading, we have fast execution of orders with 99% of all orders filled within seconds. So that gives forex an edge. So anytime there's an order, there's 99.9% of a probability that the orders will fail within seconds. So, and profit and loss starts counting immediately. There's always a buyer and a seller in the market. So while in equities and bond and in the financial markets, the execution of orders take place only when there is a willing buyer. So when there's no willing buyer, then you're just going to wait until you get one. But in the forex market, there's always a buyer and a seller. So you have high liquidity at all times, as proven during the global financial crisis. In the forex market, there's high liquidity all the time, and proven during the financial crisis. While the equity and bond markets, liquidity depends on just market settlement. So when there's a market sentiment, and then you could get liquidity. When there's no market sentiment, you liquidity. So ability to profit from rising and falling market gives FX an edge. So when the market is rising, you're making advantage and selling off that which you need to do, selling off, and when it is falling, we're going to be selling too. When it is rising, sorry, we're going to be buying. So while in the equities and the bond markets, you can only profit from the rising market. When it's falling, or everybody's crying because the market will be crashing. So we are in the forex market, we have lower margin requirements. While in the equities and the bond markets, we have higher margin requirements with equities and bonds. So we have also another advantage of the forex market: leverage of 1:100 to 1:200, and even more. While in equities and bond markets, very low leverage in equities. And I'll tell you what a leverage means. Leverage is the scenario where you could trade big capital, you just holding just a small, right? So that gives forex an advantage. So you could have very small capital and you could access bigger funds to trade and make bigger profits than what you have normally done. So no middleman involved, hence lower transaction cost. So because there's no middleman involved, just you and your system and your devices, then you're going to be making money, and that makes it very, very low cost. And then equities and bond markets will have high transaction costs in comparison to FX. Over the last few years, the forex market has seen rapid growth. So during the recent global financial crisis in 2007, substantial weaknesses of the global financial system were revealed. Faith in the once rock-solid markets has diminished, as they were revealed to be illiquid during crunch periods. Investors who once played the stock markets realized that stock prices were only as good as the value that someone would pay for them. And as prices plummeted, so did liquidity, leading to huge losses for many investors. This has fueled the move to forex trading, contributing to the rapid growth of forex trading. The market with the highest liquidity. So this is the forex market biggest advantage to us and to you. So you can expect most orders to be filled within seconds, as there is always a buyer and a seller in the forex market. With such high liquidity, it means that spreads are not expensive and market manipulation is very hard and rare. What moves the forex market? What moves the forex market? We'll be discussing that, so you can take advantage of what moves the market, so that when you see them, you're going to be making chunk of money just every day by day, just sitting and analyzing your charts. World economies. World major economies with huge power on the FX markets, and most currency pairs trade on the US dollar. So it is the largest economy in the world. Some of the major economies include the US, China, Eurozone, Japan, Britain, Switzerland, Australia, and Canada. So all of these economies have central banks, such as the Fed for the US and the Bank of Japan for Japan. And in addition to these central banks, there are players such as the World Bank and the IMF that can have large influence over the forex markets. The Fed. The Fed is the Federal Reserve Bank of the United States of America and the largest central bank in the world and the most powerful when it comes to moving markets. So whenever the Fed chairman speaks, traders around the world will pause and listen, and for good reason. It is capable of causing extreme market movements, as we've seen in the global financial crisis. Whenever the Fed chairman speaks, the market reacts either to the up or to the down, very volatile, and then you can take advantage to either sell off or buy up in those periods. But they are very very moving factor when it comes to forex trading. We have the ECB also. The ECB, European Central Bank, oversees the Eurozone on monetary policy and the health and balance of capital markets in Europe. Currently headed by Mario Draghi, it is also capable of moving the markets heavily. However, it is not as powerful as the Fed. Economic policy is a tricky process in the Eurozone as it requires all members to agree before action can happen. We also have the IMF. The International Monetary Fund is the watchdog of the economic world. It provides funding for countries that are in need of loans due to their struggling economies or are under extraordinary circumstances for which they need capital to rescue themselves. It has played a huge role in the last few years, helping to bail out Greece and providing monitoring for the euro crisis. So IMF also played a major role with like the Fed and the ECB and all governmental policies. We have economic policies. So fiscal policy is a buzzword thrown around in forex, which can be easily confused with monetary policy. The main difference between the two is that fiscal policy is executed by the government and not the central banks. An example of this was the tax policy or budgets for large governments such as the US federal government. So we have seen the effects on the markets from drastic fiscal policy when the debt ceiling in the US was not raised for some time. So monetary policy is economic policy carried out by the central banks of the country, such as the Fed or ECB. So example of monetary policy can be large asset purchases. Large asset purchases means machineries for central banks to have a loan or excessive money in the system by some various means of money printing and having loans. And we have adjusting of reserve rates, adjusting of interest rates, and expanding monetary supply. So all of these policies can have either negative or positive effects on the economy. So you're going to be taking advantage of them either to buy up or to sell off or to make your instant profit and then have good returns. So understanding the impact too. Understanding the impact. Fiscal policy is executed by the government, while the monetary policy is only executed by the central banks, which are generally separate from governments. Two, we have profits can be made from the movement by fully understanding the net impact of these policies on the economies. Three, we have pay attention to the major players via economic news to make money in the forex market. In conclusion, in conclusion, trading forex is a highly dynamic exercise where there is a strong need to understand the technical aspect of trading, as well as to be aware and constantly updated about political conditions, economic factors, and market psychology. So now this is the forex market, and you could enjoy lots of instruments in trading. This is the market, and buying at the low point. This is the British pound. This is the pair. This is the British pounds versus the US dollar. And when the market is falling down, it is falling down in favor of the counter currency, which is the US dollar, which is the currency at the right, which call it the quote currency, and to the detriment of the British pound, which is the base currency. But when it is going up, which means the base currency is going up, and then you should be buying the base currency, and then you'll be making profit, because you'll be automatically selling the quote currency. One who did sell at a high here would have made a chunk of money selling the US dollar and buying the Swiss francs, and should have made a very chunk of money at these very ones powerful rising market. So here we have the US dollar also. We have the Euro US dollar, and buying from the lows, predicting the lows, anticipating the lows, and making calculated projections makes you take a profit from buying at the low, buying the euro from the low, selling off the USD, and then taking your profit at a high, then selling off the selling off the euro and buying off the US dollar from the heights and to significant levels of profit taking before, and that's how the market goes on and on and on and on and on and on and on for our taking advantage and making our financial status drastically rise. So this is your opportunity to make it big time as a personal trader, a fund manager, and currency analyst, or even marketer in the forex market. I hope this program has been very impactful. This is introductory to our program, and we're going to be doing more instructional programs as you wait and put on your seatbelt. We're going to be impacting you with your fundamental knowledge of forex that will put in money in your pockets. I know you may have some questions, so we are ready here to give you the right answers to your questions in this program. And I hope this program will be very impactful to you. So just sit down and wait for the next program.